Hey, Robert.
Hi, Yaron.
So we both read this Substack, the new media, the Substack by Pirate Wire. Pirate Wire, I think, is a venture capitalist at Peter Thiel's outfit, I think, Founders Fund, and he writes really interesting stuff about what's going on in Silicon Valley and its intersection with cultural issues. I find him fascinating. Don't always agree with him, but find it fascinating, and raises a lot of issues and a lot of things that are going on that I'm just not aware of. And there are a number of writers that write under the banner of the Pirate Wire, and they've all been interesting, put it that way. So first, I think we both recommend people follow that. But he had this really fascinating one on what's called Operation Choke Point 2.0, what he called Operation Choke Point 2.0, which is what looks like an orchestrated attempt by the administration, really by all the regulatory agencies, to sever the links between banks and crypto, and clearly orchestrated, clearly intense over the last 2 months. Probably once FTX really, it was clear what was going on there. It seems to have all started with that. And this kind of has implications not just for the crypto market. It also has implications for the future of banking. It has implications for, I think, a variety of fintech technologies. So we thought this would be a great opportunity to talk about all this, since we've talked about it so often in the past, to kind of take a break from talking about Ingenuism in our personal lives and talk about it, go back to kind of the crypto finance banking world. So what do you make of this attempt, and what do you think are going to be the consequences?
Well, first, I want to apologize if we're giving anyone whiplash. I don't think that we're committed to a single topic ever, and that's, I mean, to have a single topic in Ingenuism would be kind of dumb. So as things arise, we'll talk about what is most relevant in our minds. And then I think Choke Point 2.0, which is a reference to past attempts by different administrations to crack down on different sectors. There's been firearms, there's been private education, there was marijuana companies. There's
porn industry.
The porn industry has clearly been under the gun for decades, and it's something that it has, unfortunately, it's followed an ingenuous process of, they seem to be getting better and more efficient at it, which is something I think we should all be worried about.
So this is about choking off these industries using the banking sector, using finance to do it.
And the banking sector is uniquely positioned to be used in this way because it's so important. So, crypto is supposed to be an alternative to banking, but when you look at how crypto is actually used today, it is adjacent to the traditional financial system. There are not a lot of things you can buy with your crypto. So, and even if you are buying a condo in Miami with your crypto, what you're actually doing is paying in crypto, and the seller is immediately converting it into dollars. People are still transacting in dollars, and we think will be for the foreseeable future, for better or worse. And so if you cut off access to the traditional financial system, you cut off access to the dollar, it does strangle the industry in the same way that, cutting off a person's neck, using their neck to cut off them from air. So it's an aptly named strategy, and the banking sector is not just critically important to most other sectors, but it's also heavily regulated, and regulated in both formal and informal ways. So you have traditional banking that has lots of rules that are mainly around disclosure and safety and soundness, but then you also have the gray areas where regulators can impact bank behavior just by saying, we're not sure you should be doing that. And the punishments are not as explicit. This is all covert. Yep. But one of the things that regulators do is they impede mergers in the banking sector. So we've seen this for decades. It was used to get Community Reinvestment Act concessions. It's been used, for years to get whatever is popular, more attention from the banking industry. And if you don't play ball, then your merger just somehow doesn't get approved. And that can be very costly for banks because the US banking sector, and we could talk about this for hours, we won't, but it's been highly fragmented for its entire existence. It's a little bit better today, but right now there are huge reasons for continued consolidation in banking to bring us to some kind of financial sector that reflects the technologies available, how people actually do their banking, which the sector currently doesn't, and brings massive efficiencies. So by threatening that, you have a huge club and you can basically make banks do what you want.
And in addition, it seems like the other club they're using is this safety and soundness, which of course is another way for them to declare certain loans particularly unsafe and certain relationships unsafe, and that creates all kind of capital requirements or reserve requirements on the banks. So there's a variety of different ways that, without actually doing anything, just indicating that they might do something, where banks are going to change their behavior because they're so dependent on, in a sense, a green light from the regulators to do so many things. And people don't realize that these banks are regulated by what, 7 different regulatory agencies, and the quarterly basis, the regulators come in, and this limits what a bank is willing to do. It just and how much risk it's willing to take. And crypto certainly is new, and there's a lot of uncertainty. There's certainly risk, and it creates hesitancy among banks.
Well, we saw 3 existing banks go heavy into crypto. By heavy, I mean just be very open to working with and participating with crypto companies. There were also a bunch of startup banks that were either acquiring, tiny banks, or looking to get charters for banks. That's a different animal. Those were looking to be a new kind of bank, but these are traditional banks. One sort of transformed itself into a crypto bank. That's Silvergate in San Diego. It went from being a traditional community bank to being something else. And then Metropolitan Bank is a small bank in New York City that was moving in that direction. And then Signature Bank, which is actually a large bank headquartered in New York City, was very open to working with crypto companies, and it never was a huge part of their business, unlike Silvergate. But they were, because they're so large, a small part of Signature is equivalent of all of Silvergate. So these 3 banks were the main on and off ramps for the crypto industry, and all 3 of them have pulled back enormously. Silvergate started it because they basically had what you might call a run on the bank, although it wasn't a run on the bank in the sense of people were worried about the bank's safety and it being shut down. But because people were looking to pull money from crypto, they were pulling what it turned out to be deposits at Silvergate, and that created liquidity problems. They had to go to a lender of last resort in order to avoid just selling their assets at massive fire sale prices. And they did some of that. So they had a huge loss. They lost $8 billion of deposits. They lost hundreds of millions of dollars in actual profit. It was a semi-disaster, and then of course everyone got worried about then you get worried about the bank's actual safety and soundness, because those kind of losses become an explicit excuse for regulators to get severe on a bank. Just there's the informal, maybe you shouldn't be doing crypto, which is now clearly the message, and then there's, wait a minute, you had all these losses. What if that happens again? Maybe we should just wind things down right now. And regulators can do that. It's not going to happen at Signature, but it could happen at Silvergate, and Metropolitan is pulled way back at the same time.
Yeah, Metropolitan's basically announced a total shutdown of its crypto asset related vertical. So I'm not sure what's left of Metropolitan, given how small it was once they do that, but that is the intention. And this, people don't know the history so much of the banking industry, but regulators have done this. They have shut down banks that were nominally healthy because of regulators viewed them as going bankrupt, as they will be bankrupt in anticipation of bankruptcy. It's a unique industry in the United States because, you know, I think he calls it in the article, and I like this. It's a public-private partnership. So, and more so maybe than any other industry in the US, government has a massive role in decision-making when it comes to these kind of financial institutions.
And I would say the three sectors are education, healthcare, and banking. And you see that in terms of the efficiencies, you know, that we provide the education in basically the same way that we did 500 years ago. It's wildly expensive, and in response to that, we talk about forgiving massive amounts of student loans because it is wildly expensive. It's a disaster. Medicine is wildly expensive, and the outcomes are not, it's not clear that spending all the money helps. Again, you would never see this in a purely private environment where people had to learn from their mistakes and they had to evolve into something that provided better service at lower cost. You would never see this kind of thing. In banking, it's interesting because it's much more of a hybrid where you have pieces of the banking industry that have gotten to be wildly efficient and had huge innovations. I mean, we all know that well, everyone over 30 knows that, you know, it wasn't that long ago that to do most of your banking, you had to go to a bank, and the convenience of a bank was an ATM because that way you could get cash without having to go into the bank and wait in line to see a teller. And that was great, except it turns out that you don't need cash and you don't need to ever see a teller. Most of us are doing all of our banking, you know, basically everything via a smartphone app. And that kind of movement is something we haven't seen in healthcare, we haven't seen in education, because they're, well, that's a whole nother story. We should talk about that another time.
Yes.
But for banking, then you have other areas that get squeezed. I mean, if you listen to what comes out of Congress, there's always a story about how, you know, a bank got bought and a branch got shut down, and now people have no alternative to banking with the predatory national banks, you know, the Wells Fargo, JP Morgan.
Or driving an hour to the branch, you know, grandma having to drive all that way, and the inconvenience of it all.
And there's to be saying that in 2023, when in 2020, grandma stopped driving to the branch because the branch was closed because of COVID, and actually figured out that you can do it online. Yep. It's just ludicrous, except that's the world that we're in. And so we have these massive efficiencies in one area, and they're limited by the fact that we still have, you know, 70,000 bank branches that are largely sitting empty. And that kind of situation only comes out of a public-private partnership, because the private side doesn't give a crap. They want to be able to say, we saved your brand so you can go in and get your coffee and your cookie, and ignore the costs of that. And the crypto is just it's the canary in the coal mine. If you're out of favor, the federal government is very willing, and they've learned how to do it pretty effectively, to effectively shut you down without actually going through the legal process of shutting you down through the banking industry.
So crypto originally was kind of an ingenuous, you know, there was a vision, I think some crypto had, about supplanting the existing banking system, creating a parallel banking system that did not require, that would not be dependent on regulators, that would be purely private. And it was, you know, they're coming up with very creative things. Some of them made no sense ultimately. Some of them, as we'd expect, some of them maybe made more sense. But they were really creating this, trying to create a parallel. But it seems like they've discovered they can't really get away with that, and that they are unfortunately also dependent on the existing, as you said in the beginning, they're still dependent on the existing banking system, and therefore still dependent on the regulators.
Unfortunately, yes. I mean, you have huge network effects in any sort of transaction market, but a payment system in particular. If it was easy to hold Bitcoin or Ether and everyone accepted Bitcoin or Ether, you could sidestep this particular issue because there wouldn't be a choke point. but it's not. Most people, a lot of people don't even know really what Bitcoin and Ether are. They've heard of it. They don't know what it is. They never owned it. And most sellers, retailers, most people are unable to use it. They don't take it. And if you could get past that, now, we could be optimistic because you can grow a network in small, like an onion, in layers, in small ways to start with, and then end up with the entire onion. The classic example is Facebook, where they started with Harvard, then they went to the Ivy League, then they went to all universities, and then they went to the entire world. Or PayPal got entrenched in eBay, and then they were able to become a global payment system. So these things can work, but that's what I'd be really interested in seeing. People who are serious about crypto being an alternative transaction mechanism is finding that first layer of the onion that isn't, hitmen, drug dealers, and terrorists. It's the problem is that it's not. It can be overcome, but the challenge has been that the core value proposition for why you would want to use crypto as opposed to using the dollars is because you're doing something illegal. And that puts you at risk. First of all, there aren't a lot of people who then want to associate to build on top of that. Everyone wants to associate when you're Harvard. That if your core business is Harvard undergraduates, it's easy to bring in the next layer. When it's hitmen and drug dealers, it's a lot harder. So that's the challenge that needs to be cracked. And if you can do that, then you eliminate the choke point. And it's going to take making it really easy. You had to make Facebook really easy for people to sign up, really easy for them to invite their friends to sign up, really easy for them to get involved. And right now, it doesn't look like that's going to happen inside of the crypto community. It looks like it's going to happen inside big tech. It's going to be Google Pay or Apple Pay, or there's going to be something that does sidestep or run in parallel, but it's still attached to, because it's not really an alternative. It's just another level of technology that makes everything run more smoothly, but you haven't detached from the dollar economy.
Yeah, I noticed that in addition to this article, the SEC is now going after any kind of crypto account that is interest bearing in any kind of form, interest in any kind of form, and declaring those securities. And because they're securities, now the SEC is regulating them and suing the companies for not registering the SEC. In other words, not anticipating that the SEC would consider these things securities. And it really does seem like a concerted effort so we might, the sad thing is we might never discover whether some of these crypto plays would evolve into this alternative, this onion or this alternative system, because it does look like there is a real concerted attempt to just kill them before they get to that point.
That definitely, this was in a lot of ways predictable, that once things started to go bad, the tide would turn really hard, because this is what the financial system looks like. If you're Congress or you're the Fed or you're the SEC, this is what you expect. We've talked a lot about stable coins and how the stable coins that are out there are either, basically Ponzi schemes like Terra Luna, or they're opaque money market funds like Tether, or I know there's an action against Binance's stablecoin right now. And that's predictable because the SEC views money market funds as entities that should register and should have certain transparency and disclosure requirements. And so for them to take something that is effectively the same thing in crypto and apply that regulatory model, it's not surprising. The staking, where you essentially are getting interest, the SEC's view is if interest is being paid, it's either a bank account or it's a security. And either one comes with a regulatory regime. And, we can talk about which one you are, but you're not a third, I don't need to be regulated from the SEC's perspective. That we both, in addition to Pirate Wires, we both, I think, enjoy Money Stuff, Matt Levine's column. And his proposal has been for a long time that you have to register as an investing idiot, and then you're allowed to do some of these things. So you have to sign a form that says, I am dumb and I'm going to probably lose all my money. And if I do, I will never complain about it. And if I do complain,
Like that.
I'll have to pay a massive fine. Uh, or whoever quotes me will have to pay a massive fine. And then you could have a set of people who wouldn't be saying, hey, I thought it was like a bank account that paid 18% interest.
And you would have companies marketing to idiots. So we only accept money from idiots. So but if you register as an idiot, please come.
Right.
And
You have to sign the idiot form before you can work with us. There would be a certain level of, it's tongue in cheek. And
yeah,
at the same time, there's a certain level of logic to it that when you take on audacious projects, they often fail. And if you're going to participate in that in any way, you have to recognize that. And the regulatory regimes in finance are designed to minimize failure. And we talk a lot about if you don't have failure and learn from your failure, you don't get rapid progress. And that's the world we're now in, is that the pendulum has swung, the tide has turned against crypto. And so there's not going to be any easy path. There might have been a couple of years ago, if you came up with a good idea for Onion Coin, where you really were going to build it out, it was going to be legit, and you might have gotten some leeway to do that. There was all this talk about sandboxes and giving people freedom to innovate, and that's all going to go away. And that's bad, and in a sense, it's also good. As the hurdle rises, we're going to see a lot less of the crap that we've seen in crypto, and anything that gets over the hurdle, I think, will have a real chance of changing the world. I don't know that it'll happen, and unfortunately, the hurdle's going to go too high, and pendulum's going to swing way too far.
Yep.
But if something makes it over it, then it's going to be fascinating.
It is interesting that smart venture capitalists like Andreessen are still putting money into crypto. So maybe they don't view the hurdle as too high yet. We'll have to see what they have cooking. So given that crypto is not going to be an alternative banking, and crypto is probably not going to be the way the banking industry evolves, just quickly, do you see a path of the banking industry getting into the 21st century in a significant way beyond where we are right now? Is the future of banking kind of positive in spite of all this controls and regulations and restrictions?
Well, I think a lot of it depends on how much freedom banks are given to redeploy their physical infrastructure. Because the thing that is, if you look at how banking has evolved versus the unregulated fintech, banking moves slowly. Banking is not about move fast, break things, ask for forgiveness, not permission. And I'm not sure we want it to be. We want there to be another thing, non-banking finance, that does that. But having something that is, we would expect to have something that's more stable and a little less crazy. The challenge is when you run into a sharp divergence between what economically should happen and what the political sentiment thinks should happen. And right now we've hit that. And it was a large part because of COVID accelerating the move to mobile banking. And some of it was just building up in the system anyway. But right now we have banks having to run large branch networks that make no sense, and regulators and congressmen and women being interested in keeping the branches in their district. And so what we have to see is some rationalization, and the only path I can see for that is to have massive consolidation in the banking industry. Because you have this problem, banks are like Starbucks and Pete's, except that they're across the street from each other on the opposite corners, except that Starbucks and Pete's are full and the banking branches are both empty. Yep. And so you need to close those branches, but it's hard to do unilaterally because you're ceding that physical market to your competitors. And it's not just access to the branch, which still does matter, but it's also the marketing, the fact that people see it. So what you need to do is merge those two banks and shut one of the branches down. And then the branches, instead of being each a quarter full, you'll have one branch that's half full, but you'll have cut half of the costs. And you can keep doing that. The branch that's on the next block, you can merge and shut them down. And now you have branches operating at a reasonable capacity, and you have the cost of running the branch network down by 75%. You have that real estate redeployed to something else. I don't know if it's an Orange Theory Fitness or it's another Starbucks, but it's something that people actually go to. And if it's not, then it shuts down. But with banking right now, you're not really allowed to do that. And it only makes economic sense if you merge. And right now, the political climate for bank mergers is as bad as we've seen it, basically since consolidation started. And that's crazy. Right now, it should be as favorable as possible because there's this massive free lunch where you can both cut costs and improve the experience for your customers. Because when you've got two branches across the street from each other, you shut down the crappy one. One is old and shabby and one is bright and new. You shut down the old shabby one. So everyone gets access to the best branches. There might be a line once in a while, but that's a perk. Right now, only people who go to bank branches are people who want to see other people. There's no other reason. You're not going to do your banking. So standing in line for a few minutes and chatting with people and having 6 tellers instead of one that's hardly being used, that's all a win. So it's
and
really,
some of the capital that is saved, I assume, is going to go into investments in technology, into improving that experience that people have. Because we know that the big banks have far better experiences generally than some of the little ones. And that's not surprising. The little ones are buying stuff off the shelf. And the big banks are designing them from scratch. And there's just a huge advantage. You need size to be able to really invest in high quality internet banking.
I agree that that's likely to happen. That the technology will continue to improve. Now we can deposit checks by phone. We can do more things. But maybe, we will never discover though unless we try. Maybe it just costs go down and banking will still be competitive because no one needs the physical branch. So maybe you'll just see interest rates that are paid to depositors go up or loan rates that are charged to borrowers go down. But the benefits will flow through the entire economy. There is absolutely no benefit to anyone in reality to keeping all of these branches open, largely empty, wasted space.
Yep. All right. Well, I'm sure we'll come back to this topic in future episodes, both the crypto side and the banking side and the convergence, if it happens or not, in future episodes. You want to say something, Robert?
I want to say that I think it will happen. I wouldn't give up on crypto, and I certainly didn't give up on the banking industry. But right now, these are the two places that the federal government and the regulatory apparatus are squeezing in ways that is the long-term costs. So until we get a better regime, it'll happen very slowly. But once we do, and I believe that the pendulum will swing back, once we do, and we're somewhere that isn't open field for fraud and scammers, but also isn't shutting down serious projects, I'm still very optimistic about the future of finance.
Great. All right. Thanks, Robert. I'll see you actually in a couple of weeks. We'll probably take next week off.
Thanks, Yaron.
Bye.